I'm gonna turn this call over to Dr. Melville so we can get started, but we need to make sure we compliant first. So Dr. Melville, over to you.
Excellent. Can everyone see the screen?
Yes.
Excellent.
Yes.
So this is our futures commodities trading group disclaimer. And it states, trading and investing carries a high level of risk. You could lose some or all of your investment. Trading commodities or any other financial instrument may not be suitable for all investors. Before deciding to trade, you should carefully consider your investment objectives, level of experience, and risk appetite. We accept no liability for any losses or damages you may incur. This means that you alone are responsible for your actions in any trading or investing activities. All righty, back over to you, Mr. Wright.
Thank you. Thank you. Great job. So we had some quizzes and that we should make sure we stay in order and make sure we go over our quizzes first. I don't know if you had some of the topic you wanted to go over today, but I had an interesting call this week where the person shared with me that they wasn't 100% clear about how the gap gets filled on the chart. They see the gap, they hear us talking about gaps being filled, but wasn't really clear about when we say the gap was filled. But anything you want to go over, we can do that. But I actually have a chart in mind. We can go over that to make sure we just go back and cover that one more time. Is that okay with you?
Sounds good to me.
Okay. Dr. Melville, are you able to grab those quizzes?
Yes, I'm actually looking it up right now.
Okay. I don't know how many we
So
had.
I think the first one was, my favorite time of the year to trade is approaching very soon. What is it that I am so excited about? And this is Mr. Wright speaking.
All right.
My favorite time of the year to trade is approaching very soon. What is it that I'm so excited about?
The grains.
What you say, Zuli?
I said the grains, the grain season.
Rain season.
And yes.
Everybody agree with that? That's why I'm excited. That's what the answer is. Absolutely, that's the answer. That's exactly why I get so excited around this time of year because I love the grains, right? So as we start approaching the end of March, I know it's coming. I actually get a chance to see as I'm traveling, I see the farmers already out in the field getting them ready, and I get excited. So that's the answer, correct? Great job. Did we have anything else, Dr. Melville? I can't remember.
I don't think so. The other one was on different types of formations, but I think that was last week's.
Okay, I think we only had one, right?
When it comes to formations that we watch for on the chart, which formations do you see? A was top formation, B bottom formation, C sideways channel, D all of the above, E none of the above.
Oh yeah, that's the one where I posted the crypto chart, right?
Yes.
Yeah. Rick, can you read that one again?
It says, when it comes to the formations that we watch for on the chart, which formations do you see? Formation or formations do you see? A top formation, a bottom formation, a sideways channel, all of the above or none of the above?
Anybody? Let me ask you something, Dr. Melville. I've got a question. Are you able to share your screen with that chart? Is that possible?
Yeah, I should be able to. Mm-hmm.
Did anybody have an answer? Anybody want to take a shot while we waiting for the chart?
Just D, all of the above.
The all of the above.
Yes.
There it is.
Any different answer?
No, because we see the side with channels, we see the top, we see the bottom. Yeah.
Yes. I chose this chart for a reason. I know we're teaching and we're learning how to trade futures, right? Well, this is not a futures chart, right? This is a crypto chart. And I chose this chart because the answer is correct. All the above. So two reasons I chose this chart. I want to explain. First of all, it had all three formations that we watch for on this one chart. The second reason I chose this chart, because how many times have we heard Johnny B tell us that if you've been around for a while, you've heard this multiple times. It doesn't matter what market you're looking at. Crypto, stocks, futures, Forex. These formations form on the chart regardless of the market. And I wanted to show by an example. Here's a chart that had all three formations on it. Just like Johnny always tells us, don't matter what market it is. But yes, it has a sideways channel. It has a bottom and a top. Does everybody see all three formations? If there's somebody that are not clear and able to recognize all three formations. I know we have new people on the call, but if you've been following since lesson 1, are you able to recognize the top, bottom, and sideways channels? So everybody see the sideways, the bottom, and the top. Okay.
You can't draw it, right? On that.
No, that's a
Petition.
no,
Yeah.
no, that's a screenshot.
Yeah, no, yep. Hang on a second.
Oh, Johnny might be able to.
So I'll stop sharing. Oh, you can draw, Mr. Don. Oh, great.
Can everybody see Johnny drawing on the chart?
Yes, I can. Very good.
Yes, I can.
Awesome. So what we can see is that we have a channel, and then we have a bottom, we have a top. And we have a real small 1, 2, 3 bottom in where Johnny circled. If we were to zoom and make that bigger, you would probably see it. If you can't see it, I don't know if everybody able to see it because it's kind of small. But we have a 1, 2, 3 in that little small circle. So the reason I wanted to use this chart to show you that even on the crypto chart, here are the same formations forming. Yep, you see it, Johnny just marked it up. Awesome. All right, Johnny, man, you said you okay with going over the gaps?
Yes,
I got
sir.
a chart. I got a chart I wanted us to look at to make this clear for those who are not actually 100% clear about what we mean that charts form on gaps form on the chart. Dr. Melba, if you could share your screen once again
Absolutely.
and go to that market that you're the queen of. And let's look at that May contract for OJ. And I want to start all the way over to the left and just let's go through each trend that's on the chart. There's going to be multiple gaps on the chart that we can talk about. So if you're not familiar with what I was talking about, we deemed Dr. Melba queen of OJ a while back. And she was all over OJ for a while. And then a hurricane hit down in Florida And she got all discombobulated with OJ. But
Haven't been right since. And I can't shake the queen. I've been trying to give it away, but nobody wants it, so I gotta keep it.
yeah, so when we talk about gaps on the chart, we also always mention that in most cases, these gaps get filled at some point. Key word I said was most cases, not all times, but in most cases, these gaps get filled at a later date because charts do not like gaps. So we also talked about how gaps form on the chart. How does the gap get on the chart in the first place? The market closes at one particular price, and when it opens up again at the next session, it opens at a totally different price from where it closed from the previous session. And that leaves a gap on the chart. So we're looking at a chart where we can see that if we start from the very left of the chart and start to go up, we will see that there's a lot of gaps on this chart. But I want to go through from trend to trend and see, does these gaps get filled at some point? As we can see, what Dr. Melba cursor was, there's a lot of area right here where gap formed on this chart, right? And we talked about gaps being filled at a later date. Market can't come back and trade back in time and trade over that day where the gap actually formed on the chart. But at some point it trades through that same price range where the gap is on the chart. And that's how we feel the gap. So if you notice the gap that's over on the left, that gap is on the chart at that particular time. As we move on higher and the trend goes higher, and then the trend starts to turn down, we see another gap that forms on the chart. Actually, two gaps form right here on the chart. So how does these gaps get filled if we can't go back in time and cover right over that space? At some point, at a later date, the market will come and trade through that same price range. If you look to the right of where Dr. Melba arrows are, you'll see that the market traded right through that range, came up and traded through that range, which filled that gap. But we also had some more gaps to form in that time frame when the market traded down from those gaps. Now you see where the gaps got filled over to the right? Right after we filled the gap, we actually ended up getting some more gaps on the chart. So how did these gaps get filled? Over to the right, you see where the market turned into a downtrend. We traded down through those prices, that price range, and then we filled that gap. Of course, we have some more gaps that form on the chart. You see that gap right there where Dr. Melba cursor is circling? If you look to the right, the market traded up just enough to fill that gap and then traded back down. Leave another gap, and then to the right of that, you see that we went back up and filled that gap. Over and over and over again, we see gaps form on the chart. And then at a later date, we came back and filled the gap. We keep going through each one of these up and down trends. We'll see gaps being left on the chart, but we see where they got filled at a later date. Over and over and over again. You see that where Dr. Melba is pointing at with the arrow? Over to the right, the market traded up just enough to fill that gap and then traded back down. It just keeps repeating itself over and over. You can see these gaps forming over and over on the chart. And at some point, the market comes back and keeps filling these gaps. Anything you want to add, Johnny?
Well, at this point right here, notice that is where it filled the original gaps that we talked about.
Yes. All the way to the left, right?
Correct.
That's where we fill those gaps all the way to the left, correct. Thank you, Johnny. And it just keeps happening over and over and over again. And the market comes back to fill the gap. And it was mind blowing to me when I first started looking at this on these charts. And I, was understanding that charts don't like for gaps to be on the chart. And it comes back to fill those gaps. And then I got to read more in the manual because I know I remember reading about it. So I went back to find it in the manual. And then I said, okay, I forgot all about this, but now I see that these gaps form on the chart. And then I started learning the strategy, how to trade the gaps. So we use these gaps when it comes to our trading because we know that the market in most cases is going to come back and fill them. It's not the easiest thing to trade because you're not always sure that it's going to come back and fill the gap. But it's a strategy that you can take advantage of. Dr. Melba, if you keep going on up the trend over to the right,
Over here.
and then come back down. Yeah, come back down. Look at the gap that filled to the left, and over to the right, we fill the gap again. Right here, look at this gap that her cursor is going around. Over to the right, the market went traded up just enough to fill that gap again,
Mhm.
and went back down. It just keeps doing it over and over again. I hope this helps to understand what we mean about when the gap gets filled. Again, the market can't come back in time and trade that day where the gap is actually left on the chart. It can't go back and fill that space because that's in the past. But what happens, it comes back and trades through that price range at some point. And that's how you fill the gap. Hope everybody's clear about that. If you got
Sorry,
anything else,
Can you
wanna
go
add
over
that?
how,
Hmm?
Mr. Wright, can you go over exactly like how that gap forms to begin with, like what the market is doing that leaves that space in the chart?
Yes. So the market closes at, let's say the market closed at 1100 on Friday evening, right? Matter of fact, where did the market close on Friday? Can you scroll down a little bit, Dr.
Three-
Mill?
367 point, oh, I'm seeing, oh, on the, here it is. 367.70.
Okay. So if you see where the market closed at, when the market opens back up on Monday morning and it opens higher than that price, let's say it opens at 375. If it opens up at 375, but it closed at 367, because we didn't trade at the 375, we open at 375, it leaves a gap on the chart. Okay. So it opens at a different price that it closed at. And because it didn't trade up to 375, it just opened up already at 375. That leaves that gap on the chart. And a lot of times you'll see it happen when the market is making limit moves. When I say limit moves, we always remember that in the futures market, most of the commodities that we trade, they have what's called a limit. So that means that at some point, the market trades to a point where it's reached the limit that it can trade for that trading session. And that's called a limit move. When it'll be up, that means it's a limit up. If it was down, then it'll be called a limit down move. But that happens a lot, and that leaves gaps on the chart as well. Anything you want to add, Dr. Melville?
No, I just wanted us to go over that.
Yes.
Yeah.
I know you like to trade and spot the gaps a lot too.
Yeah, I do. Yes, I
Yeah.
do.
We can use these gaps to our advantage once we start to recognize them on the chart, and we can use these gaps to give us when we're looking at the market, we want to know, all the analysis that we can take advantage of. We want to look at all the angles, and when we're looking at the market and looking at the chart, and we see gaps on the chart, we keep that in mind. We mark up our charts, we point the arrows, and we point out these gaps to let us know that this is something that may come back and get filled at some point. So we want to know that while we're trading. So
Mr. Wright, would you like to take all questions at the end of the class?
I would, but we didn't state it. Do we have a question?
Yeah, Ray T. Henry has a raised hand.
Okay, come on, Ray T, what you got?
Yeah, I'm so sorry. I was busy watching your videos. I was like, ah. But anyway, nevertheless, I was looking at bar chart and I was looking at lumber, May 2024, and
Mhm.
there's a gap there since you're speaking of gaps. And
Mhm.
I wanted to see if you guys looked at it, and then I wanted to start, maybe testing out with the brokerage account that I'm doing, and I'm trying to figure out, looking at the specifications, doing all the procedures. Could you walk us through one like that you don't use, like corn? I know you do corn, but I was wondering if we could do one that's different.
When you say different, tell me what you mean.
I mean, I'm looking at lumber.
Uh-huh.
That's a different commodity that you don't use. You usually do corn.
Yeah, I'm glad you pointed this out because I want to make a point that when you mentioned lumber, you said that you don't hear me mentioning or talking about lumber, right? Lumber, there's a reason that I don't, Ray T, that I don't mention or talk about lumber that much. Lumber is not a real liquid market. It used to be a long time ago, and it's not real liquid, and that's why, for the most part, you don't hear me talking
That
about
was a good chart, Dr. Mama.
Yeah, but he's talking about a liquidity, which is the volume of open interest, correct, Mr. Wright?
Correct.
Right.
I
Yeah.
saw that it was low. I just wasn't sure, because I was like, I would like to get in. I saw the gap, but like you said, the volume and the open interest is low. So that
Yeah.
is one of the reasons why you wouldn't touch it, right?
Right. We always want to understand that that's very important when it comes to our trading. Remember how we talked about what we bring to the market? Why we so important to the market?
Mhm.
Because we bring liquidity, right? And liquidity is what we want to have. We want to be able to get in a trade and get out of a trade when we need or we want to get out, right? And that's what we don't have in lumber. We don't have liquidity. We can get in the trade and maybe be trying to get out of the trade for days because there's not a lot of open interest, meaning there's not a lot of contracts being traded. And it's very important to make sure you understand when you get into a trade, you want to have open interest. That's one of the main things. You want to be able to get into a market and have no problem getting in and no problem getting out. Does that make sense?
Yes, thank you. I won't touch it then.
You you probably didn't what you was looking at was the fact that it had some gaps on the chart, right?
That's correct.
Yeah, it forms a lot of gaps on the chart. It's a fast moving market. It's just not liquid. Not a lot of people trading it. Yep.
That was a good question, Ray T. Thank you.
And a great observation. She noticed that I never talk about lumber, and that's why.
Yep, very good question.
Yes. You see the gaps on the chart there, Johnny B?
Yes, sir.
Yeah. One thing about that lumber though is it used to be a more liquid market and very very liquid market back at one time. But if you watch that call when my broker came on the call, he talked about this actually on that call. If you watch that recording, you listen to it, you hear him talk about lumber and how it's not that liquid anymore. And actually he actually fringe if I actually even talk about that. As a matter of fact, I wanted to tell y'all about this, but I'll tell you in a minute when we get to. I want to tell y'all about some story with my broker real quick. But when it comes to lumber, I really like the way it moves. I just wish it was more liquid, right, T. I do. I like the way it moves.
So, Mr. Wright,
Hmm.
Mr. Joshua put in the chat, gaps are a sign of illiquidity. Can you guys explain that? Gaps are a sign of illiquidity.
He may not can unmute. I don't know if he can.
Mr. Joshua, are you available to explain that to us?
There may be why he put it in the chat. He may can't unmute.
Okay.
But
So gaps are a sign that we can't get in and out of that market as easy as we would like to, is what he's saying?
Now, what it means is that there are either no buyers or there's no sellers at a given price. Okay. And so because there's none of each, then the market trades up higher. Let's say, for instance, there's news that, and this happened in lumber. We had a pandemic, and then all of a sudden, there's nobody that can work in the factories. So there is no lumber. So because there's no lumber, nobody can, the supply had dropped, and then all of a sudden the price or the demand has increased, but there's no lumber to be had. So the price skyrocketed. Okay. But since there's no sellers and only buyers, all of a sudden the offer price goes up, but nobody's willing to sell at that price. So all of a sudden, nobody can get in a contract, so it goes limit up. Okay, you understand that? There are no sellers, there are buyers, but since there's no sellers, there's no liquidity, so the price goes up until it hits limit. And when it hits limit, the market closes for a period of time until it opens back up at a higher price until a seller is willing to sell. Conversely, the other way around is if the market falls apart and nobody's willing to buy, then all of a sudden the price drops until it hits limit, and then reopens again until there's a buyer who's willing to pay the price. So there is no liquidity in that area, and the price either drops or either falls or rises until there's either a new buyer or a new seller.
Got it. Thank you so much.
awesome job, Johnny. Awesome job, man. Couldn't have said it better. I don't think Josh could have said it any better, right? Perfect, man. Perfect. So are we all clear about the fact that gaps form on the chart, how they form on the chart, how the market fills the gap, and what transpired for the gap to appear on the chart? Everybody's clear, right? All right, all right. One more subject I wanted to make sure we were clear about. And then I would feel okay. But we have a challenge with this subject every time we do the course. And I want to make sure we all clear. And if you're new, I know we have a lot of people that are just joining, and right now you probably are at a stage where you're looking at the call from the very beginning, lesson 1, lesson 2. So what we're talking about right now may be a little foreign to you, but just know that you still got the other videos to go back and watch. But, the other subject I want to make sure we're clear about is everybody's clear about how we short the market and do what's called trade the market to the downside. Everybody clear how we trade the market down and make profit when the market is trading down. Is everybody clear about it? Matter of fact, Dr. Melvin,
Yes, sir.
if we could pull up the my current trade, the cotton trade,
I'm sorry, I missed you on that.
cotton. Can we
Okay,
pull up?
Yes, we can.
Y'all made a see where I posted that I went short one May futures contract and cotton. So we always want to understand that we can trade the market from two directions. We can trade it up and we can trade it down. And when we trade the market down, that means we're making money, we're making profit when the market is trading in a downtrend. All right. We need to be clear about this. And at some point in our life, everybody's familiar with, everybody's heard of buying low, selling high. But in this particular scenario that we're talking about, the concept is selling high and buying low. The complete opposite. Same thing, it's just reversed. We're trading the market to the downside. So if you saw my post, our order was filled, I forget. What would I feel at, Dr. Mel?
I think it was 92.75.
92.75. And I said that I sold one futures contract at 92.75 for May cotton. All right. So when we are shorting the market, when we trade the market down, we do the opposite of when we trade the market up. So we sell first. We have to sell first. When we trade the market up, we buy first. We buy low, we sell high. When we trade the market down, we sell high and we buy low. So if I sold it at 92.75, I need to exit this trade lower than 92.75 in order for me to see a profit. If I was filled at 92.75 and I get out of this trade at 92.76, I lost on the trade. But I need to get out of this trade lower than 92.75 for it to be a profit. So we always want to know the point value of anything we're looking at, any market that we're watching. Okay. So we know that this is cotton. Does anybody know what the point value for cotton is? 1 point equals how much?
$500.
Okay. So from 92.75 to 91.75, that's $500. Hope everybody's with me. From 92.75 to 91.75, that's $500. And the same thing the other way. Okay. In this particular case, I'm trading the market down. So I sold it at 92.75. In order for me to make a profit again, I need the market to be trading down. So where did the market close at on Friday, Dr. Melvin?
It closed at 91.53.
All right. So every time the market tick $5, go down 1 point, how much am I making?
$500.
Every tick? Did we look
No.
at the tick?
No, it's every point, $500.
Every point, $500. So what is my profit at this particular time? 92.75, and you say the market closed at 91.53.
53.
Who can tell me what my profit is at this point?
$500 and some change.
92.75 minus 91.53
53.
equals, no, 92.75 minus 91.53. So 1.22 points times 500 per point, $610 profit.
Yep. $610 profit, right? Now, how do I exit the trade? If I wanted to get out of this trade right now, how do I exit the trade? How would I get out of the trade, Jamal?
Not exactly sure. I'm still paying attention, but not exactly sure.
Come on, guys. Come on, come on, come on.
Do you do a market
Think,
order?
think about it. Think about it. He sold a contract at 92.75. What does he have to do to get out of it?
Did you put a stop loss?
Huh?
Put a stop loss?
Don't make this complicated. He sold a contract at 92.75. What does he have to do to get out?
Just does he have to buy it back, or does he just put
There you
sell
go.
to buy it back?
He has to buy a contract.
There you go. So, Johnny, I've always heard people say that the car illustration helps them understand. So, I got to use it again just to see if I can help people understand. But I'm going to use the Yukon. I like Yukon, so I'm going to use the Yukon as the example. I want this Yukon. I already know what color I want. I know I want the Denali Yukon. I ain't ready to get it yet, but I'll be ready in June. I got a friend who sells cars named Johnny B. I'm going to go see him. And I go to see Johnny and I tell Johnny that I'm looking to buy a Denali Yukon. You know, I want a black one. I tell him I want this and I want that one. Now, what Johnny is gonna do is negotiate a deal with me, and we're gonna work out a deal where Johnny is gonna have this car for me in June that he's gonna deliver to me in June, and we're gonna go ahead and do the deal today. So we work out a deal. Let's say we work out a deal for $50,000. Johnny sells me the car for $50,000 that he's gonna have to have ready to deliver to me in June. All right. Now, the way that this makes sense to most people is the fact that you understand that he has till June to find the car. But if Johnny can't find the car for less than $50,000, does Johnny make a profit?
No, he does not.
No.
If he already sold the car today,
Mm-hmm.
he knows what the car is sold for because he already did the deal with me for $50,000. He needs to find the car for less than $50,000 to deliver to me so he can make a profit on the deal. If he can't find the car for less than $50,000 and the best he can find is $52,000, what happened?
He's lost $2,000.
He lost $2,000 on the deal. But let's say Johnny finds this car over in California somewhere and ships it to, over to Texas so he can deliver it to me. And he found the car for $40,000. Now what happened?
He profit.
Profit about 10,000.
He profit $10,000. He sold the car first. He sold it first. Same concept we doing when we trading. Same concept. We sell first. And then we need to buy to get out of it. What's the concept when we trade the market to the upside? We buy first. And then we got to sell to get out. It's just complete opposite. But just understand, when we're trading, when we sell first, that means we're trading the market down, we're short. When we buy first, that means that we're trading the market up, we're long. And I use the month of June as an example because we trade futures, right? So Johnny has between now and June to find the car. Does he have to wait till June to give me the car? Let's say he found the car next week. I told him I'd be ready in June, but he can go ahead and buy the car and hold it, right? He can go, if he find a good deal next week, he can go ahead and buy it. Right? In this case, it's the same scenario. I sold at $92.75. I need to get out of the market less than $92.75. I sold it first. We're doing the same thing. Over you, John.
I don't think I can explain it any better.
That was really good.
It's the same concept, everybody. I just need y'all to know that we are just doing the opposite of buy low, sell high. And if once you get that in your mind, it'll click and say, oh, okay, it's the same thing. We just reverse. Now, in this case, with this cotton trade, I sold it at $92.75. But what made me get into the trade? Why did I pull the trigger? Why did I get into the trade? This is what Johnny normally asks everybody, right? When Dr. Mel or Barbara talking about a trade, Johnny wants to know what made you get into this trade? What happened on the chart for me to get into cotton at $92.75? We have formations we watch for on the chart, correct? Do you see any one of the formations that we watch for on the chart? Bullseye. Now, would that be a bottom or a top? Anybody? Come on, y'all. Is that a top or a bottom?
It's
A
a top.
Thank you. It's a top. Now, why did I enter at $92.75? Who's been paying attention to these formations and how we enter the market? Why did I enter at $92.75?
Step below the 2, right at the tip of the wick of the 2, number 2.
The number 2 is our what? Floor, as our support,
Yes.
right?
Yes, yes.
I want to see the market trade below the number 2, right? And then I want to have a limit order to enter right below the number 2. So if you notice that over to the right, when the market traded down the other day, my order was filled at $92.75. But if you wonder, well, why did I get in the trade? What made me get in this trade? There's your reason. Does everybody see this? One, two, three, top on the chart. We wait for the market to confirm. Like Zuli said, we want to see the market trade down to the number 2, past the number 2 to confirm that it is a top formation. And I'm ready to get in the market. That's why this trade happened. Anything you want to add, Johnny? Dr. Melvin?
No, I'm good.
Um, where would your stop be?
Okay, in this case. Dr. Mel,
Of
you
the
want to
number
explain
three.
what my stop is? Dr. Mel, you want me to?
No, you go ahead and explain this one. Oh, this stuff is outrageous.
Now, my stop would be above the number 3 in most cases, right? But if we understand the point value that we just looked at, if you go and do the point value and come back to this chart and do the math, I know Dr. Melvin is smiling over there, but if you do the math, you will realize that the risk that I would be taking on if my stock was above the number 3, it would be crazy. Remember, we always want to know what our risk to reward ratio is. So placing my stop above the number 3 is risking way too much on the
Mhm.
trade. So
Yeah.
the other strategy that I use when it comes to placing my stop is a trailing stop 2 days behind the market. If you heard that on the video, I use the same strategy. Dr. Melvin uses the same strategy. Barbara uses the same strategy. So in this case, my trailing stop is 2 days behind, not above the number 3. It's too much. Does anybody know how much money that would be if my stop was above the number 3? Just
Huge.
see. Does anybody know how much that is? How much did we say?
500.
How much did we
Probably
say a point was?
500.
$4,500 you would lose.
Yep, 4,500 on the point. Very good.
Very good. Do I want my stop that high?
No,
Not at all.
Mm-mm.
no.
I'm risking too much to make a little. Does that make sense? That doesn't make sense. So we don't trade like that. So that's why my stop is 2 days behind. So what does that mean? Dr. Melvin, talk to her. What does that mean when I say it's 2 days behind?
Okay. So we have to look at where he's entering the trade. So the market came down and went past the number 2 and his order got filled at 92.75. So probably his order got filled on 3/19 or on 3/20 out of those 2 dates. So let's say it's 3/19. You count 1 day behind, 3/18, another day behind, it says 3/15. Okay, so the highest of these two is right here where it spikes. So your stop loss should be right above the highest point within the 2-day range behind where he entered the trade. Even if he entered here on 3/20, 2 days behind would be 3/19, 3/18, you're still at the same spot. The highest point of the last 2 days behind where he entered and got filled.
Excellent. That's what my stop is, Johnny B.
Thank you, sir. Although that's not a gap at the 2, if it was, then that's also something we'd be talking about,
Mm-hmm.
correct?
Correct. Correct. That's what I wanted to go over today, John. I wanted to make sure we
Okay.
went back and touched on gaps and make sure we got clarity and make sure everybody's clear on shorting the market. When we say that we can trade the market down, so we understand what that means and how it works. So I hope we got clarity and got clear on how that works today. But unless you got anything else, Johnny, we can open up for questions or comments.
I'm good, I think.
Thank you, Dr. Melvin.
Oh, you are very welcome.
Any questions or comments of what we talked about went over?
Yeah, Ray T has her hand raised, sir.
Please unmute. Who? Ray T?
Okay. Yes, sir.
Okay.
Okay, so on your cotton, So the
Mhm.
minimum you have to put on margin would be, is it, I'm looking at the specification. Does it
Mhm.
say it there? How much you have to put up to start this trade?
Margin and
Yeah.
maintenance, yes.
Okay, so it says 3,000. So you have to continue with 3,000 in this particular cotton, right? With
So
cotton.
that's the margin I need to have to be able to enter into the trade, right? I need to have 3,000. Remember I told y'all in the very beginning, lesson 2, when we talked about this? Think of the word margin as deposit. Remember that? And think of the word maintenance as balance. So just think of the fact that's a deposit I need to have to get into the trade. Three grand. Do I have to risk 3 grand on the trade? That's what I need to get into the trade, right? Now I can determine what I want to risk out of the 3,000 once I get into the trade. If I only want to risk $300 on the trade, I only risk 300 of that 3,000. Does that make sense? So, but that's the margin for me to get in the trade. That doesn't mean I'm risking 3,000 on the cotton trade. You follow me?
Thanks.
You good?
Yes, that was good.
Okay.
Whatever she sets her stop loss at, Mr. Wright, is what she's risking, correct? Of that 3,000?
Correct.
Okay.
Yes. Yeah, we wanna be able to trade another day, as Johnny said, right? But we definitely don't want to risk more than we can afford to risk. But great question. Great, you have some great questions tonight. I appreciate
Yes,
that.
yes, she does. Excellent questions.